Well, hello everyone. Happy December 2021. Don Garman here from Mirador Capital Partners, here with a couple weeks left to go in the year, just to share some probably final thoughts for this year as we head into next. Some of you have noted, and certainly we have as well, that the markets have been unsettled, and obviously the S&P 500 being held up by really the strength of five companies, the sort of large tech five, which account now for such a huge percentage of that index. But underneath the surface of that, right, would be the very strong tip of that iceberg. Underneath, there has been massive carnage and massive destruction of market value in stocks that, in some cases last year were doing very well. And now have kind of given a lot of that back and then some, and looking for some clues as to where we might head next. So wanted to share just a couple of thoughts I had about that. So the script that we've been following for some time, as you probably know, has to do with earnings and the direction of earnings and the rate of increase or decrease in the growth rate of earnings. And so there are some signs underneath the surface that the next year, or let's say 3 quarters, might mark a directional change, perhaps even in the direction of earnings. And what we really worry about are when earnings are rolling over. You can look to that period of the pandemic when earnings really fell off as they shut the economy down and ask, well, why didn't the markets fall out of bed? Which of course they did in March and then sprang back. And it had to do with that massive accommodation that the Fed put into the system, what I've referred to as the drugs in the arm of the patient, called the US economy, that really kind of buoyed things and kind of got us to the other side. Well, we're at the other side. So now we are in the, perhaps final innings of that narrative, that particular playbook. And the Fed meets tomorrow, and they're probably going to announce the either acceleration in the tapering, which is the amount of bonds that they buy in the open market, or even perhaps accelerating interest rate increases, which, if we think in our own lives, have pretty drastic impacts on some of the behavior that we witness, that we take ourselves and that we witness our friends take, that affects affordability of any things that might need to be financed. So that obviously has impacts on a whole number of other things. So what it does immediately is it puts into question the high multiple growth stocks or companies. When you're trading something at 14 or 15 or 20 or 30 times future revenue, you're really implying and imputing a bunch of things into that. And a lot of those things require zero interest rates to justify. So that's kind of the first thing that's happening, is that's where the severe destruction has been seen most acutely. On the flip side, if we are going to see longer periods of higher inflation, and the Fed, we're seeing signs of it all over the economy. People are making more money. People are changing jobs rapidly to make more money. And that creates wage pressure, which can be a very insidious, durable type of inflation that can persist for some time. I've said this before, but I'm going to say it one more time. If that is the case, and it's too soon to conclude that it is, we have a playbook that we believe will work in that environment. So that is kind of the argument that's being had inside the marketplace as we are, currently experiencing it, is that, we've gotten a lot of whipsaws, a lot of up and down movements in drastic percentages day by day as this sort of debate is being had in real time. That's tension, which will give way to one or the other of this tug of war, kind of prevailing. And when that is in evidence, then we have a way that we will sort of pivot into that or shift. If it is 4% inflation for the next 2 or 3 years, a certain subset of companies will do very well in that environment. We will load into those, or we will move harder into those. If the reality is this inflation that we're seeing turns out to be this sort of flash that dissipates, which can also be, seen in certain places, then it could be, the large cap tech trade has yet further to go. hard to imagine, right? These are, this is the perennial trade for the last 3 or 4 or 5 years. But for those of us who are around 20 years ago, remember that a lot of the companies that seemed like slam dunks at 80, were pretty hated at 10. And I don't necessarily think I would predict that for the large and loved names that we all see and know. But we can say that there probably will be a shift in that narrative at some point, and we need to be aware of that, because that will put a massive pressure on the indexes in general, which we're always attuned to. So if it seems ungratifying that we don't have the exact answer today, what we do know is whatever happens, like I know the tendency is when the calendar rolls off December, then everything changes into January. That's not necessarily the case, and that certainly isn't how we're seeing it at this point. We just have a ongoing battle that we have to continue to fight that is unending, because we always have to be aware of what could be next and what could be changing. We start first with what do we know we want to own? What risks do we know we want to take? And then we add in things that we think could go our way, or things that could contribute positively, and sort of pack it in that fashion. The biggest challenge we've had this year, of course, is in our aggressive strategy, where the idea of that strategy is you have to populate it with things that are a little less clear, and you have to, for us, we use size as a way to demonstrate, conviction. And occasionally, when you get out of cycle with those, it is acutely painful in the short term. In the past, that has always been followed by very pleasant periods, which are equally, acute but pleasant. And so I would say, I believe that's how this will end as well. But time will tell, and we continue to look at the positions that we have in there and try to size them according to our conviction. It's like a lot of things, if you stay with your process, even though your timing isn't always perfect, eventually the process will prevail. And I think that will be the case here too. So I will leave it there for now. The thing I think I will probably talk about in our January video has to do with the earnings charts that you've all seen so many times now, which I think are starting to signal some flashing yellows that we're monitoring. But before we get to that, we've got 2 weeks to go in the year. We hope you all have a wonderful holiday season with your friends and loved ones, and get some rest. And we will load up again in 2022 and start the calendar year all over again. Can't believe this year's gone so fast, but once again, we appreciate you all. And if you have any questions or concerns, don't hesitate to reach out. And until then, happy holidays, and we'll talk to you soon. Okay, bye.